Okay, so I'm Kit Lyle. I'm with the Operators, which is the world's leading community for private equity backed executives. So you're in this session presumably because you have an interest in working in private equity, or perhaps you already have. We've been going through a series on value creation. We're now on our fourth lever. What's to come is the fifth lever is add-on acquisitions and integration. And then sixth is exit planning. And Joyce and I exchanged emails. We're hoping to get those two sessions in before the end of the year. So I think the next session is November 20th. Is that right?
Yes.
Okay. And then we'll pick a date not too late in December to do the sixth session. So before I dive in, any questions of me about this topic, about what we've done in the past, or about the operators? I put into the chat my contact information, or at least my email. I didn't put the LinkedIn address. So if you have any questions, feel free to reach out to me directly. I'll pause for a few seconds to see if anybody has any questions. Okay, well then I'll go ahead and start sharing my screen, and I'm going to start with a couple apologies. There we go. Okay, and I'm going to pull you all over here. Okay, and good. All right. So the first apology is I have a cough drop in my mouth. So I've got a cold, and so I hope that's not too distracting for you if I sniffle. The second apology is there is a lot of repetition in these sessions. So those of you who've been in the other sessions, we carry these out with one topic but a number of sublevers. So in this case, there are six sublevers to this topic, organic growth, go-to-market strategy. For each of those sublevers, we go through four stages because each stage is different. But as you can imagine, there is some carryover, so there is some redundancy. So I'm just apologizing for that in advance. So we have the first stage you'll see is due diligence, then the first 100 days, then the hold period, which is like the next 3 to 5 years, and then preparing to exit. So I may just save my voice and just leave the slide up. Did the slide just advance for you? If I could just get a thumbs up or nod. Okay, good. All right, cool. So big picture, high level, we're trying to decide if the market is attractive, if we're well positioned relative to competitors, if we're serving the right customers, we understand what their needs are, so we can target them more effectively. That's basically what this is all about. So, marketing excellence, we really want to have measurable, predictable outcomes and be able to focus on KPIs that matter so we can track our performance. Marketing leads the sales, so sales excellence is data driven and understanding of how successful we've been, and then putting in place opportunities for people to perform. So, incentive plans, for example, we'll get into the details. This is just very high level. Leadership and communications, we're really focusing for today's session on communication with third party external to us as we prepare to exit the business. These are the six sub levers that we'll be going through. It follows a fairly logical sequence. And there's my first sniffle. Sorry about that. All right, so we get into sublever number one, understanding the market. And essentially, what we're trying to do here is decide, is this market attractive enough for us to invest in the first place? Is the company well positioned relative to competitors, capability, strengths, strategic direction, etc.? And are we choosing customers that care about where we are strong? So, in other words, I'll just give you a simple example. I had a client once that was very proud of how shiny and red and beautiful their finished product was. But one of their leading customers was asked at one point, do you have an unmet need? And they said, yeah, the coating that you put on it, that shiny red stuff, it's pretty, but we always have to scrape it off to do what we need to do to it. So if you could just stop putting that shiny red coating on it, that would be great. So obviously they thought that what their differentiation was valued by their one of their largest customers, but it wasn't. So we wanted to just understand, are we targeting the right customers? Do they care? What are their unmet needs? How can we serve them better for retention purposes? During diligence, It's many of the same kinds of questions that I just mentioned. So I think we can move forward into first 100 days. In the first 100 days, so assuming that we bought the company now, we're looking at, refining the go-to-market strategy. Basically, we're looking for opportunities for growth. This whole subject is not about cost reduction. It's not about systems. It's not about financial engineering. It's just about revenue growth. The whole session here, the whole value creation lever that we're dealing with, revenue growth. So we want feedback loops. We want to look for white space, opportunities to serve the market that we may not be tapping into. So for example, if there's a segment of the market that's growing very rapidly and has significant tailwinds, but we're not in it, maybe we should explore that. Sparring with the board, making sure that the signal to noise ratio is low, which basically means there's no brand static, which means we're saying very clearly and precisely what we're good at and what our focus is, and narrowing the aperture to customers that really care about that a lot. And then we're just improving the process of sales delivery, if all that makes sense. And obviously jump in if you have a question. I can see most of you, but not all of you. So just vocally or maybe into the chat, you could put a question and Joyce will notice it. So then during the hold period, which may be 3 years, 5 years, even longer, the steps are tracking, paying attention to the key performance indicators, continuing to investigate, have an intelligence program, gather data externally. So that's market data, customer data, and competitor data to understand where you fit, where you sit relative to everybody else in the market. Be ready to pivot. And as I said, monitor market developments so you can change in real time. You don't want any surprises. Preparing to exit, it's really about the narrative. We want to be able to tell a compelling story about scalability to potential buyers. So in other words, we want those buyers to look at this business and say, wow, this is impressive. They have an engine, they have a machine that's replicable. No matter how big we get, they will be able to continue to do what they're doing as we grow and link strategy to execution, differentiate, and have loyal customers, which we'll get to in a minute. But loyal customers is really important because that's the low-hanging fruit. That's the easy part. And a lot of private equity-backed portfolio companies do not pay attention to loyalty, customer loyalty. So that was the end of the first sublever. I'll pause there to see if you all have any questions. Okay, well, you'll see a familiar process as we go through this. So now we're getting into customer specifically. And as I said, the most overlooked lever in private equity is not cost cutting, it's not systems and processes and technology, it's not financial engineering, it's just plain old customer success. So retention means you have predictable continuing revenue opportunities and you can enhance you can enhance the margins by just doing more with the same customers. And how do you do that? Well, let's start with diligencing the acquisition target. How do they onboard customers? What support and service do they offer? Is there concentration risk? What's the net promoter score? You all are familiar with net promoter score, even though you don't perhaps recognize the terminology. How likely are you? Imagine you just took your car in for service at the dealership. You probably got an email or a text that said, how likely are you to refer or recommend us to a friend on a scale of 1 to 10? That's the net promoter score. And then lifetime value of a customer. During the first 100 days, we want to look at customer success. We want to look at onboarding, upsells. What's the nature of the relationship? Are there things that are not optimized that we could take advantage of and fix? We want to monitor very specific key metrics. That the CSAT is customer satisfaction score, and basically the health of those customer relationships. We want to enable customer feedback in real time, and then obviously pay attention to that and respond to that. Be able to segment the market so we can proactively go after segments that are more attractive than perhaps the ones that we're in. Change the compensation structure for salespeople. And then sometimes you have to customize support for certain customers, and sometimes you don't want to do that. So ideally, if you have a homogeneous group of customers that all have the same unmet needs and like wants and wishes and purchase decision criteria, then you can do everything the same way to that segment of customers, and that's really convenient, but it doesn't always work out that way. And then during the next few years, as we think about making this into something that's automatic, we have to have dashboards that connect to you all in finance, and so we can visualize. What I love about this series of topics that we're having here and conversations that we're having here about value creation is that so much of it comes back to you all in finance and being able to share numbers with operators that are in the driver's seat to make strategic decisions. So previously we were talking about operations, in other words, COOs. Today we're talking about chief commercial officers, chief revenue officers, heads of sales, maybe heads of strategy, transformation. So dashboards, visibility. We want to do voice of the customer research on an ongoing, continuous basis. Track risky customers, flag them, pay attention to them. Do things to increase the level of stickiness or loyalty. Revisit the segmentation. Pay attention to the 80-20 rule. If there's a very long tail of customers, meaning, if you look at where does 50% of revenue come from, hypothetically, let's say 50% of your revenue comes from 20 customers, but the second 50% comes from 2,000 customers. Ugh. So maybe that's something that you can change. Maybe you have to rationalize customers so you can focus more attention and time and effort on the ones that matter. Adapt to the needs of buyers, and then just essentially build into the process retention, retention, retention. As we sell, it's essentially a narrative, i.e., a story. You want to be able to present to a buyer the story of change. So this is what the way the business looked when we bought it. This is what we did to it. Here are the numbers. This is the impact that we've had. Here's our playbook for the future. And in showing all that, you're de-risking. In other words, just earlier today, I had a conversation with somebody about what's the definition of value. So if you asked 10 private equity professionals to define value creation, we'd probably hear 15 different answers. It's funny how, such a common term, value creation, can mean so many different things to so many different people. But at the end of the day, it's pretty simple. It's a multiple of earnings. And the multiple, whether it's 6 times or 12 times, the multiple is determined by really just 3 things. Is there predictable revenue growth, which is what this subject's all about? Have you de-risked the business, eliminating risks, concerns that a buyer might have? And have you made wise, shrewd investments that a buyer looks at and says, oh, great, we don't have to do that. That's awesome. They're scaled up. They're ready to continue to grow. That's why people pay premiums for businesses. All right, so we've gone from customer into marketing, and then from marketing, we'll go into sales specifically. And I have to take a sip of tea. Hang on in there. Okay. So a lot of people in private equity associate marketing, think of marketing kind of the same way they do culture. It's fluffy, it's soft, it's qualitative, it's ethereal. It's not real. It's not like businessy. But that's not really true because you're really engineering the way you can create revenue. So the first thing we have to think about is who is our customer and what is their specific profile or persona? Who are they? What is their need they're trying to solve? Then what's our brand? Meaning, what are we promising to do for our customers? We don't brand ourselves specifically, as weird as this sounds. Customers brand you. The brand is all about what does somebody say about your company when you're not in the room? That's a brand. And then we have messages to influence our brand or value propositions, how we're going to solve unmet customer needs. Then we want to spend to get that message out. How successful or efficient is that spend? We want to track the results with KPIs, customer acquisition cost, return on investment, response rates from cold outbound, and then process maturity, meaning it's efficient, it's automated, it's sequenced. Then we get into the first 100 days, and there's certain things that will change. I think the main thing is sales and marketing have to be compatible, collaborating, working together, um, joint KPIs. In many cases, they're kind of pointing fingers at one another. So there's the word automation again and brand differentiation. Okay, so over the next several years, the shift has to happen internally amongst the sales and marketing teams from maybe perhaps complacent. What do I mean by that? In the lower middle market of private equity, many acquisitions take place in which the private equity group acquires a founder led business. Many of you have probably worked in founder led companies. And not to be disrespectful, but I've done the same thing. When you work for the founder, you're not exactly complacent, but you're a little bit reluctant to say, hey, wait a second, there's a better way to do this. We should take advantage of this better practice. Because by doing so, you're essentially, insulting the person that's played every role and made every decision throughout the growth of the company. Well, that culture cannot continue when it's owned by private equity because private equity doesn't buy the past. They don't buy complacency. They don't buy like status quo. They're buying the hope that you can take the business from where it is today to where they want it to be in 4 or 5 years when they sell it. And that means change. And change is hard for human beings. So that's why that says culture shift for continuous improvement. Paying attention to the indicators, optimizing campaigns, segmenting proactively. And then as we prepare for exit, it's the same thing we've been saying, but now we're getting into more with marketing excellence. It's proof points, in other words, the numbers and documentation, demonstrating the brand and the strength of the brand. But at the end of the day, it's really about the team, the quality of the team. So trust in team. Moving right along, now we get into sales excellence. Yeah, so a lot of sales teams are not built for the pressure cooker of private equity. And many successful sales executives, maybe they have a hero in on the team, and the hero maybe doesn't work particularly hard, but is bringing home an enormous income and doesn't really want that to change. Well, in a private equity world, they don't necessarily want one or two heroes. They want everybody performing optimally. And so they're going to change the compensation structure of the sales teams so that it is aligned with the goals and objectives of the company overall. So, really, what that means is the objective is not to just increase revenue to increase revenue. It's not just to sell something and get money in the door. It's all about value creation. So, we want EBITDA. Remember the formula? EBITDA and revenue growth plus risk reduction plus wise, shrewd investments. So, in diligence, we're going to pay attention to the CRM and figure out what that's telling us. Does it look sophisticated? Do they are they taking notes? Do they have a CRM? CRM, maybe I should explain, is a customer relationship management tool that allows you to just take notes with the conversations that you have and organize the outbound emails, for example, to customers. So HubSpot is now the gold standard for CRMs. Sales process diligence. So they're looking at things like what's the conversion rate? How does that vary by segment? How long does it take for a customer to make a buying decision? Um, and a lot of that data translates directly over to metrics that you would pay attention to as well. And then during diligence, we're going to look at the organization, meaning the sales team. How strong, sophisticated, mature is the sales team? What are the incentives? Is there anything that we should change there? Again, that concept of heroes. We don't really like heroes that stand out. We want everybody performing similarly. And then are they targeting the right sectors and segments of customers? So, you know, if the average deal size is very different by segment, maybe if we have an extremely profitable type of customer, but the deal size, the project size, the win rate, the dollars that are coming in are low, then we have a decision to make. Do we really like that really profitable stuff that's small, or do we prefer lower profit, big ticket sales? So that's a decision that has to be made. And then again, we're just looking for white space, meaning where are some opportunities for us to grow with customers, segments, channels, end markets, competitive domains where we're not today, where there might be opportunities for us to take advantage of. And so then I'll just leave this up here while I take a sip. These are the things that you do over the first 100 days, and then they're similar to what we do in the next 3 years. Any questions here? Okay. So tracking KPIs. Yeah, question?
Yeah, I have a question. So I can understand why a seller wouldn't want a private equity firm to contact key accounts for references, but do you have some ideas around how to determine the reputation in the marketplace, the strength of the customer relationships, and so on with just internal data as well as whatever external data may be available?
Well, you asked the right person, Chuck. It just so happens, in addition to wearing the hat that I'm wearing today, I'm also the founder of a consulting firm called Aclaro Growth Partners. And that consulting firm does this type of due diligence and sell side market studies. So hypothetically, I was just talking to a guy named Dave Ring, who used to be the CEO of a concrete. Let me see if I can. When you pour concrete and then you use a float to skim off the top and make it smooth on top. So it's a company that manufactures a machine that does that. So my point is, really weird, obscure, nichey, sub segment that you've never really thought about as a market before. Those are the kinds of markets that my company, Aclaro Growth Partners, studies. And in doing that, when we do the market study during diligence, we always insist that we have a list of, say, the top 50% of accounts, lost accounts, prospects, and the top 50% of current accounts. And what we tell the seller is we are never going to mention the fact that an acquisition is taking place. We're never going to mention the name of the buyer. In fact, this is going to blow your mind. We're not even going to mention your company by name. We're going to mention the competitors, two, three. We'll sprinkle them in, and we're going to wait for them to say, I don't know those guys. We use a company called Ligsheen. Oh, tell me more. Tell me about Ligsheen. How'd you find them? Why do you use them? So it's a really cool way to disarm the people that know most, and then you're just asking them a series of questions. It's an intellectually stimulating conversation. Now, we don't report back what Bill Smith said, but if you do that enough times, then you get a very, very accurate sense of what customers like and don't like about the company. Did that help, Chuck?
Yeah, that helped a lot. Thank you very much.
A question. So a couple companies, family-run businesses acquired from PE. We had real difficulties implementing CRM systems or anything kind of along those lines. Any thoughts or input on how to best kind of sell that?
What were some of the challenges that you faced in implementing the CRM?
Yeah, they didn't, people didn't use it before. They had their own methods. Everybody was kind of, this was kind of different businesses, different locations, so it wasn't kind of centralized. It was different regions had different, obviously different customers and stuff, but it was just difficulty getting people to actually put the data in and use that.
Yeah, yeah. So I think, two things come to mind, Steve. There's not a this is a common problem, particularly in smaller businesses where the sales teams have never used the CRM before and it's a bit intimidating and the technologies may be intimidating and so forth. But the two suggestions that I have are number one, they have to see what's in it for them, understand like this is why this is beneficial, and figure out how to connect the dots for them in that sense. And then secondly, there has to be accountability, meaning a weekly meeting in which you discuss the pipeline, and that discussion of the pipeline happens by looking directly at the CRM. And if sales team members haven't input their data, then it's like, okay, well, you didn't do your job. Like it has to be part of the job. And that has to be tied to compensation as well in some way, shape, or form. So I hope that helps, Steve. I mean, it is a common, and HubSpot is not the right tool for everybody because it's very complicated. It is not intuitive. It's maybe not the starting tool.
Yeah, I think one of our challenges was is in a lot of cases the operating managers or the regional managers were basically the guys doing the sales at the same time. So it was kind of dual roles. It wasn't really kind of a dedicated sales staff.
Yep. Jonathan.
Hi, Kit. Thank you. The last section you were talking about is kind of making changes, making early changes, maybe from the sales perspective here and growth and EBITDA growth. A couple of situations I've had in recent times was, talking with two different companies. One was PE backed, they were both originally owner operated. One was bought by a PE company, the other one was kind of on the verge of it. And, they said up front, we want somebody to help us make changes. We're not professional. We don't have CRM. We don't have a sales team. We don't know how to sell. We don't know how to do a lot of these things. So I went in and kind of as an ex-corporate person came in and said, wow, this is a really fruitful ground for a lot of improvements, right? So much so that I think it scared away or scared off and spooked some of the internal people saying, oh my gosh, you're going to come in with all these big ideas. This is too much. This company cannot tolerate this kind of change. And so, I think if there was the PE voice, that wouldn't be as much of a concern. But I guess, maybe some advice on those of us talking to small companies, how much outside thinking can you bring in? Because in some cases they get spooked by it and say, oh, we cannot tolerate that kind of change here. So we'll find something smaller and less ambitious.
Yeah, Jonathan, I'm not sure if this is going to be helpful or not. There's a former operating partner from the Riverside company named Steve Cliff, who developed his own, what's the right word, intellectual property around assessing management teams for their change readiness. Excuse me. And I've partnered with him to do consulting work in small private equity backed businesses that were just acquired. Because when you read an investment thesis, when you read a value creation plan, the verbs that you read all involve the word change.
Right.
Enter, upgrade, professionalize, etc. So the management team has not learned to speak the language. They have not learned to ride the bicycle. And so really what's required is teaching the team the power of change, continuous improvement, finding better practices, increasing the profitability, and then the benefits to them of higher profitability personally. So, I mean, that's super oversimplified, but I just wanted to acknowledge that it's a common concern because, a friend of mine was a fractional operating partner working with a small, I don't know, we'll just say industrial business. And one day he walked in and, the factory floor was extremely warm. It was the summertime. And so he said, what's going on? Like, how are you guys working in here? This is not like a safe working environment even. And they just said, oh yeah, it's that AC unit up in the second story. It just, it goes on the fritz from time to time. And so then, he starts down this 5 whys, right? Well, why? Well, there's this guy who's supposed to do some kind of maintenance and I don't know, he didn't show up last week or well, why? And you just get into these small businesses where it's just like ultimately it's just some guy's responsibility and nobody else was trained to do that job and silly stuff happens. So I get it. Sorry for the distraction, everybody. Any other questions before we go on? All right, good questions. So this has been up long enough. You've had a chance to read it. During the hold period, really, ultimately, what we're doing is hoping that we've developed a team that is firing on all cylinders and has accountability, feedback loops, doing the right thing. It's really all about the people and people doing the things that they've been asked to do. I don't know how many of you, just by a show of hands, are familiar with the book Traction and the EOS Entrepreneur's Operating System? Anybody? So Chris, yeah. Well, I mean, he cites something. The book is fantastic, by the way. It's called Traction. And the entrepreneur's operating system is a very good concept for smaller companies. One of the principles that he talks about is something you've probably heard before. If you have a vase or a cylindrical shaped container, a bucket, whatever, and you want to put into it water, rocks, and sand, you have to put them in the right order. So if you start with the water and the sand, there will never be enough room for the rocks on top. So you have to start with the big rocks. So his point is, in small businesses, they don't always recognize what are the big rocks that we have to focus on first and get done. They're often dealing with like little sand and water stuff. That's just the little stuff that's fluttering around that's annoying. So anyway, moving on. So now sales excellence, we're preparing to exit. So we want a scalable sales process that people can look at and say, yeah, they've got a process that works. It makes sense. There's no heroes. So the representatives are essentially plug and play. Everybody's capable. There's a compelling story about the pipeline. We have incentive plans that cause everybody to do the right things. And they're incentivized by the right metrics, right? And then we have clean dashboards and KPIs that are compelling. That's sounds easy. So now we get into two more levers. These two are having good commercial discipline. We'll define that in a second. And then the last one has to do with communications. Commercial discipline is all about focusing resources where profit is most obvious. So we want to focus on the most significant opportunities, like the big rock story. During diligence, we're asking ourselves, is revenue concentrated in a handful of accounts? Obviously, we don't want customer concentration risks. That's a bad thing. Have we overserved unprofitable segments? So remember that long tail. If we've got 2,000 customers that make up the bottom 50% of revenue, that's a lot of small, like a lot of stuff. And are we over servicing them relative to the way we're servicing the top 50% of customers? Customer acquisition cost. Are we spending too much money to acquire a new customer, or does it make sense depending on the lifetime value of the customer? Which products or customers generate the top 80% of margin? And are we focused on that? And then is the team allocating their time proportionally to the biggest opportunities? All right, first 100 days, we want to look at conversion rates, margin risk, and velocity reported alongside EBITDA. So my point in this slide is essentially to say, you finance folks, don't think of yourselves as salespeople and finance people don't always communicate, but they depend on you for a lot of good data. So you have to understand kind of how they think and what they're looking at. How are they allocating resources in the sales, marketing departments, in the commercial departments? Do they have a good cadence for feedback, reviews? Are the playbooks buttoned up, and do they have well-defined processes? And are sales and marketing working together collaboratively? It doesn't often happen. We want to understand and have a process for gaining intelligence about the external environment, customer, competitors, and markets. So we want to use data analytics. So in my translation to you is quantitative data is what you're most familiar with, a customer survey. On a scale of 1 to 10, how likely are you to refer or recommend? Or on a scale of 1 to 5, how did we perform today? Qualitative is what I was describing earlier to Chuck. It is having primary research conversations with people that are just qualitative, subjective, just a discussion, not numbers, not specifics. Discipline focus on clear target. In other words, is there clarity around the brand, the positioning, what the messaging is? Are they fixing things along the way? And is there a focus on profitability? In other words, we're not going after customers just to go after revenue opportunities. We want to go after the customers that represent the biggest profitability opportunity. Commercial discipline, preparing for exit. Commercial excellence is discipline, data, differentiation. So remember, we're making sure with this sublever, we're making sure that we're targeting the right customers and giving them the right amount of attention. Any questions on that one? Okay. Last one. Now we get into communications with third-party stakeholders. So beyond the boardroom, turning third-party relationships into strategic value. Communication with this ecosystem is often neglected in the rush to optimize internal operations, yet perception directly influences customer trust. So really, we want to make sure that we're sending the right message out to maybe the community, for example, could be channel partners, could be ultimate end customers. And during diligence, we're evaluating how does the target interact with that ecosystem. Who is paying attention to them, meaning who's paying attention to the acquisition target, what is being said about them publicly, and then what is our company communicating. So conversations, communication is the baseline of trust. And so if there is an opportunity to look at reviews, for example, from customers, we want to do that. If there's an opportunity to look at media comments about the company or even small town newspapers comments about the company, we want to understand all that. In the first 100 days, we want to influence. So this is really kind of like public relations strategy. We want to have some talking points. We want the executives to be visible to people that matter and focus their time proportionately. We want to make sure that we solicit input from people that matter. So that could be channel partners. It could be vendors. It could be community leaders. We want their input. We want their feedback. We need to start thinking about scenarios. Last time we talked a lot about scenario planning. That came up again and again. But here again, what are some crises or scenarios that we can plan for? What would we say in the event of something? And I'll give you a simple example. It was, gosh, I don't know, October 16th, 2023. I think that was maybe a week after the start of the war in Gaza. I had a member of our community who's in a peer advisory group that I run. He brought up this case in our peer advisory group. The case was, okay, the Israeli Defense Force is a client of ours. What do we say to them? Should we say anything? Should we have one message for them? Should we have a public message that says the same thing? Should we have one message that goes here and one message that goes there and it's slightly different? How do we handle this? And what we realized is that sort of crisis communication, nobody's really prepared for. You need an expert. So try to get yourself prepared. It's hard to predict every possible scenario, of course, but what do you say to a customer? Brand campaigns. The credibility of the messenger often outweighs the content of the message. And how do you develop credibility? It's through continuous conversations. Then during the hold period, we want to cadence out the engagement with them so that it's not a surprise. It's not a random thing. It's like a regular, recurring, structured cadence where we have consistent narratives. There are talking points, there are brand messages that we want to stay on point with. We want to monitor the feedback that we're getting on our brand. And then, community involvement, community goodwill as well. And all of that matters because when a buyer does their investigation of the company, one of the things they're going to diligence, as we've already discovered, is what do the customers think about this company? And any other proxy, it could be a channel partner, it could be any other stakeholder. What are they saying? What's being messaged? So any bad news that you can prevent is potentially uplifting the value of the business.